Fantastic. Good afternoon, everyone, and welcome to the Munro Partners virtual investment briefing. Thank you all for tuning in. My name is Zane Layden, and I'm a Senior Distribution Manager at GSFM. I'm responsible for servicing South Australia and Victoria. Now, today's Munro Partners investment briefing with Nick Griffin was originally meant to be held in person. However, the COVID-19 restrictions and the border closures between Vic and SA has meant that we've once again had to pivot online. We appreciate your understanding and would like nothing more than to be presenting this to you face to face, and we will be rescheduling the in-person roadshows for a little later in the year, likely August or early September. We also have a number of attendees on the call from Melbourne, so thank you for joining us today, and I'm sure we're all looking forward to getting out of lockdown and supporting the local businesses that find themselves in a much tougher situation than us. Now, Nick, we want to make today's virtual session as interactive as possible. So those on the line, please do ask plenty of questions throughout, which can simply be done by typing in the Q&A box toward the bottom of your screen, and we'll look to answer as many of them as possible. Now, Nick, I'm pleased to be joined by yourself. Nick is the co-founder and chief investment officer of Munro Partners and portfolio manager of the Munro Global Growth Funds. Nick co-founded Munro Partners back in 2016, and they've had some great success ever since. They're currently managing in excess of $5 billion in assets, with their flagship fund, the Munro Global Growth Fund, being a little bit different in the global equity space in that it is absolute return focused. So long short with a long bias and an ability to protect client capital via puts, currency, cash and shorts. The fund is fast approaching its 5-year performance track record, having delivered just in excess of 16% per annum, with typically lower drawdowns of volatility versus the market. For everyone's information, the Absolute Return Fund is rated recommended by Lonsec and Zenith, available across the major investment platforms, and now via an active ETF on the ASX under code MAET. Munro Partners also have a long-only version of the fund, which adheres to the same investment process, however provides investors with a concentrated, currency unhedged, fully invested global equity offering, which I'm sure we'll touch on today. Nick, as I mentioned, we've got a great turnout. Many of the call are fantastic supporters of GSFM and Munro Partners, so we certainly thank them for that support. And we also have quite a few on the call that are a little less familiar with Munro Partners and the funds. So with that in mind, I now pass over to yourself, Nick, to provide a short business update and where you're currently positioned to benefit from the key structural opportunities in the world, and perhaps why today represents a fantastic opportunity to be looking at investing in the Munro Global Growth Funds. And then we'll go straight to Q&A. Thanks, Nick.
Yeah, thank you, Zane, and thanks everyone for dialing in. You should be able to see my screen, Zane. I'm assuming, yes, correct?
Yep.
Yeah, and look, so sorry we're not there. We were just discussing the wonderful Italian restaurant that we normally go to in Adelaide, and have a really nice meal and a really good chat with you all. It's usually quite an interactive session in Adelaide, which we really enjoy. And just sorry that we're not there. Unfortunately, beyond our control. And fully look forward to getting back maybe the other side of the financial year and making sure we all catch up soon, because this thing is clearly nearly over. So I'm going to keep this fairly short in terms of introduction. I know you guys are many on the call are fairly familiar, but I will do a short introduction. I'll talk a little bit about the market, and then I'll talk a little about what we've done with the fund. But then please do use the Q&A session to sort of get any of your questions out there, your concerns, etc. Happy to address those, because obviously we're all on a journey together with Munro Partners, and the journey can be bumpy. Okay, so just really quickly by way of update, we are so we set the business up nearly 5 years ago, as Zane said, to be your global growth manager. So our goal when we looked at the Australian market was there was just no one really doing global growth very well, and no one doing it in that absolute return format that Australian retail and high net worth investors particularly like. So we're a global investment manager focused on growth equities. We're coming up to our 5-year anniversary. We've done 16.1% per annum since inception. But part of the reason why we've managed to grow quite quickly to $5 billion is because the same process we actually ran at our previous firm for 10 years, where we also did 16% per annum since inception. So we now have a 15-year track record of over 15% per annum returns, which is a good track record. Unfortunately, it's not a straight line. I wish it was 1.5% every month. It's just not. There are many bumps and twists and turns along the way, and I'm sure we're going to talk about some of those twists and turns today. But we want to be your global growth investor, and I think part of the reason we've been successful is A, because people have realised that they need growth equities in their portfolio, and also part of the reason we've been successful is because we do that with your downside protected format in the Munro Global Growth Fund, and so happy to touch on those issues today. Just also by way of introduction, the business is a partnership. We're all based here in Melbourne, Australia. We have continued to grow the business. So some of you who would have seen me over the last couple of years would have seen a lot less faces on this slide. We're now up to 18. And we're in the process of getting some new digs here in Melbourne to give us room to go all the way to 25. And so from that point of view, we continue to invest in the business. We're obviously okay at what we do. We're pretty good at what we do. We still think we can get better at it. Our job is to find these great growth companies around the world and help them represent a portion of your portfolio. And it's something that we take very seriously, but it's something that is always a process of continuous improvement. And I think that's something we'd expect the numbers on the slide to continue to grow, and hopefully we will continue to get better at. Just quickly by way of introduction, I'll do this very briefly because I know some of you have seen it before. But just to remind you that ultimately when we look at putting a portfolio together, our philosophy is to find growth. So earnings growth drives stock prices. Sustained earnings growth is worth more than cyclical earnings growth. The market always misprices growth and its sustainability. So put really simply, when we're trying to put these portfolios together, and I think this is probably a little bit different to what some of you get to do every day, is we have the whole world to look at. We have the whole world to basically put together a portfolio of roughly 30 to 50 ideas or 20 to 40 ideas in our long only product. And so our hurdle for finding companies is quite high. And so what we've generally found over the years is to really focus on these structural growers on the left, like MasterCard. The blue line is its blended forward earnings per share, and its black line is the share price. And on the right is Bank of America. The blue line is the share price. So the blue line is its blended forward earnings per share, and the black line is the share price. And so what we've generally found over the journey, quite simplistically, is stocks ultimately follow earnings in the long run. And certain stocks can grow structurally over a long period of time. And so our job is to ignore the Bank of Americas in the world. I'm not saying they're bad investments. They might be for a year or two. But really to try and focus on the big structural winners, because it's those big structural winners that drive you to the excess returns. And if you can find them in a concentrated portfolio, that's really what you're trying to do, and that's what we're trying to solve for you at Munro. The reason why we do this, and again I've showed this slide a lot, so I'll do it quickly, is we just think it's all that really matters. We generally find that equity markets are horribly overanalyzed. People, go over or underweight countries. They go over and underweight sectors based on interest rate outlooks and economics, and it's all completely irrelevant. The reality is equities are driven by very few winners, and those winners are driven by their structural earnings growth. So what we're showing you on the left is that, a simple study done by a guy called Henrik Bessenbinder a number of years ago. If you took every company that ever listed in the United States over the last 90 years, it's actually 25,300 companies. Yet less than 1,000 of them create the entire wealth of the entire stock market. So 14,000 effectively go to zero, 8,000 only offset with the other 14,000 lose, and you end up with just 1,000 that generate the entire wealth. So 4% of all statistical observations. And the top 50 of that 1,000 make up nearly 50% of the wealth. So that's 50 companies out of 25,000 over a 90-year period have created nearly 50% of the US stock market. That's what happened. And if you plot those companies over time on the right, the simple observation is that there's always structural change that creates them. It's got nothing to do with the economy. And so whether that's digitalization here in the near term, software, big box retailing, entertainment, air travel, consumer staples, it's always the same. Something changes, i.e. the internet comes along, everyone tries to win, a couple of companies do win big. Software, big box retailing, it's always the same. And so our job really is what we're going to talk a lot about today, is to identify the big structural changes that are occurring in the world and try and identify the winners. And this really comes back to what I said at the start, is we have the whole world to choose from. We're trying to build a concentrated portfolio. And we're really just trying to identify those structural changes that you can't actually get access to in the Australian market and make them part of your portfolio. Because obviously many of you, I'm sure, are sitting there watching these companies disintermediate companies you're investing in, whether it's, Facebook and Google in the media, or whether it's climate names in energy today. And from that point of view, our job is to really to do that for you in your portfolios. And as Zane says, the other update that I have skipped, unfortunately, along the way here, is we're trying to make that easier and easier for you every day. So we do that with the absolute return fund, the long only fund, but also we now have the absolute return fund quoted on the stock exchange under MAET. And so what simply happens is if you wake up one day and you buy some mate today, then tomorrow you wake up and you own Danish wind turbine manufacturers or Taiwanese semiconductor foundries or US software companies. And the day you don't want it anymore, you sell it. And that's really where our product fits. And that's really a short summary of what we're trying to do. Okay, so that's the introduction done in record time. Please use the website if you want to understand some more. So let's just do market outlook really quickly. A lot of people are getting, they're quite hung up on this at the moment. And I'm sure I'm going to get lots of questions in the Q&A about inflation and a whole bunch of things. I suppose what I'll try and do here is try and just get everyone to take a big step back and look at what's really driving markets. So what drive markets generally, or equity markets, is their relative valuation versus other asset classes. This is a good slide that shows this. So here we're taking the equity risk premium of the S&P 500, which is effectively 1 divided by the PE. So the PE of the market, say it's 20, it's actually 21 today in the US, but it says 20. It means you're getting a 5% earnings yield for owning equities. You subtract the US 10-year bond at 1.5%, you're getting a 3.5% carry for owning equities. And if you track that process over time, you'll see generally equity markets are pricing at about a 3% carry for owning equities. So I think that's about right. That's actually the average equity risk premium over the last 40 years is actually 3.5%. And so markets as we sit here today look fair. The big problem, as we all know, is that if we look at this chart over time, we know that the risk-free rate has gone from, say, 6% back here in 2008 to 1.5% today. And so all the market has done is priced in those lower rates over time. And the reason why it's done that is because of the problem that every single one of you have every day, which is that your clients effectively walk in and say, I'm not earning anything in cash, we need to go take risk. And you go take risk in some form, whether it's with us or with a credit fund or with a private equity fund, etc. And so the markets have effectively priced in these lower rates. And so from here, what would actually make the market get expensive? What would make it actually get back to this sort of 99 level where we're potentially in trouble of a big downturn? And there's three things. One is earnings could not stop going up. So if earnings actually went down a lot, then this equation would close, i.e. the earnings would go, the PE would go up and the equation would close. We think that's highly unlikely from here. We're in an economic recovery. If anything, earnings are actually surprising to the upside. So that's actually a supportive part of this equation. The second thing that can happen is the market can go up a lot. That's what happened here. The market goes up a lot and closes the equation, i.e. the PE multiple keeps going up. We don't think that's likely from here. The PE multiple is already quite high. If anything, the PE stays flat and the market just gets effectively driven by those growing earnings. And so the last big risk is the one you're all going to ask me about is the interest rates go up. So if the interest rates go up, then that will close that equation, not make the market look fair value as it does today versus things. And so this really becomes the epicenter of the discussion today is where are interest rates going? And then by definition, where's inflation going? Because inflation will drive interest rates. And so again, if we just take a big step back, this shows you nominal GDP over a 30-year period, 40-year period in the US, 45-year period in the US, and shows you the US 10-year bond yield and the debt outstanding. And so what you'll see is that we've actually been through a long period of nominal growth slowing and nominal bond yields falling. And I think most of you are aware this has been happening for quite some time. From our point of view, the structural forces that are creating this are still there, which is that debt is rising. Debt is rising dramatically. Debt eventually has to be paid back. I know we're not really at full modern monetary theory right now. The Biden administration is still talking about raising taxes. So as you pay back debt, that becomes a crimp on growth, or it slows down growth. It's the same for the consumer who has all this debt that they can't actually spend too much money. If anything, the spending we're seeing now is just because they've actually been through this inordinate period of savings through COVID. And so this mini cycle has been created within what is this really quite deflationary period. The last thing I'd just flag on this point is that the role that technology plays to obviously keep inflation low. And so I haven't built this chart yet, but it's actually quite a good chart that I'm going to use in the future. But what's fascinating about this little COVID period is the US GDP last month got back to the previous point it was back in 2019. In fact, Australian GDP did exactly the same thing. But in the US, you've now got back to your pre-COVID levels, yet you've got there with 8 million less employees. So you sacked 22 million and you've only hired 14 back. So 8 million employees disappeared for the same amount of GDP. And that's just a great example of how much productivity we created through this period. And that all comes down to technology like Zoom and all these things that we use through the period. And so to think that that's not going to happen again in the future would be flawed. The technology growth we know continues. And so from our point of view within this chart, we do feel that yes, rates will go higher. That's not uncommon. We saw it happen back here in 2016 when Trump got elected. We saw it happen back here when we came out of the financial crisis. But in neither cases did they go dramatically higher. And both times, once the initial move has happened, the rotation stops. And ultimately, you go back to just following earnings growth because earnings growth is what actually drives stocks in the long run. And so provided interest rates don't go much above 2.5%, we should be fine. And so from that point of view, yes, this is a tail risk that we end up back here in a stagflation point of view, but it's a tail risk for everybody. It's not just us. It's not just your growth manager. Your property, your bonds, everything's in trouble if we end up back there. And that's when our capital protection tools will have to come in handy. Yes, that's a tail risk. It is a low probability outcome from here. I think the most probable outcome is the one that we can all handle, which is interest rates drift back to 2.5, and ultimately earnings growth drives stock prices over the medium term. And so our job really is to build a portfolio of companies that we know can grow earnings over the medium term, and quite frankly, just not pay too much for them. And if you do that, the earnings growth will drive the share price, which will ultimately drive us towards our returns. Look, last thing, just in terms of outlook, and just a quick little slide here. Look, I know there's lots that can still go wrong, and I'm sure it'll come up in the Q&A, like China, like inflation, like COVID coming back, etc. It is important to stress, and on politics, there is important to stress on the right-hand side, there is a lot that can go right here. You know, we have actually just been through a period where a lot actually went wrong. And again, I would just take a big step back and maybe just pass on my personal experience in 20 years of markets. And obviously, I don't know what's going to happen next, by the way. I know everyone dials in thinking we do, but, you know, I did not see COVID coming. The financial crisis sort of caught you out. It's always the things that you don't see coming that catch you out. But generally, in our experience, what we find is generally when one of these really bad things happens, so this is the volatility, the VIX of the S&P over the last 20 years, generally when something really bad happens, you know, like the financial crisis here or like the tech wreck here or like COVID, everyone spends the next 5 years trying to predict what the next really bad thing is going to be. But actually what happens is you actually go into these long periods of low volatility, which are actually really good periods for making money. And it feels like we're heading off to one of those now. And so that is something, you know, that I'm truly thankful for, because these things are never fun. They're always hard to get through. We managed to get through the last couple okay. But it's always nice to have things a little bit calmer. So that'd be our market outlook. In terms of how we position the fund, again, regular viewers would know it's all about the S-curve. The S-curve beats the macro every day of the week. And so as much as this narrative, and I know it's getting a lot of airtime at the moment, it is effectively just a narrative. It's important to remember that, you know, inflation is the narrative of today. Last year, it was the US election. The year before that, it was the trade war. The year before that, it was Donald Trump. The year before that, it was the European crisis. There's always a narrative every year, and it always, you know, it gets a lot of airtime because people just want to talk about it and they need to fill column inches and they don't want to talk about things like this. And we think things like this are more important because they work no matter what. And so an S-curve this is the great one, which is the mobile phone one, which I show all the time. But, you know, you used to sell 1.6 billion phones per annum in 2008. You sell 1.7 billion phones in 2008. But smartphones come along, go from a 10% share to an 80% share. Lots of companies lose, like Nokia, Ericsson, Motorola, HTC. One company wins, Apple. Its revenues go from 27 billion to 250 billion. So its revenues went up 10 times, predominantly driven by the iPhone. And it happens no matter what. It happens whether you have a financial crisis. It happens if Europe goes broke. It It happens if North Korea launches missiles. It happens if Donald Trump gets elected. It happens if you have inflation. It happens if you have deflation. The stock ultimately followed its earnings through these periods. And so these are the things that I think are more profitable to look for rather than trying to worry about these narratives of the day. This is what we try to focus on and these effectively become our North Star through these difficult periods. The big S curves we've been following for some time are still not completely finished. So e-commerce is literally, only 25% of retail sales in the US, and we think it goes to sort of 40, 50%. That's where it is in China. Cloud computing is 40% of all workloads, but the workloads that are going to the cloud are expanding massively as well. So arguably, it's still only less than 20% penetrated. Digital advertising is much more penetrated, up at 50% now from effectively nothing. And digital payments is nearly 100% penetrated now. It's crossing through 60%. These are some of the companies that we've owned over the last 10 years that have driven our performance that enabled these big winners to happen. And so in many cases, it's things like Amazon and Google, Microsoft and Visa and MasterCard. And for many of them, we're not actually getting off. We just don't see the logic in getting off here when there's still so much more to run for. And if anything, we've learned the lesson from Apple, which we actually got off in 2016 here, and it doubled. We made 7 times our money on Apple, but it doubled again after we got off. And so for many of these, we're not getting off at this time. And if anything, we're still finding great ideas that are coming along in the background. So HelloFresh is a great example. ServiceNow and IT and Uber. There are still other great digital winners to come along. The one change we have made, and so that the regular viewers will know that we had a few more slides on here. So the one thing we have obviously done is that we had a lot more sort of, I suppose, new generation or emerging winners in here at the start of the year. Those companies were obviously high valuation. And in many cases, we decided to move to the sidelines on those. Ultimately, we have become respectful of the inflation argument, and we respect it's out there. And so ultimately, it does feel like, the higher multiple stuff will struggle at least for the next 12 months. And so from that point of view, we've tried to condense back to the bigger cap, or I suppose the lower multiple versions of the same thing. And so while we may have owned Microsoft, ServiceNow, Adobe Free, and Atlassian, and Twilio, we've now condensed it back to the bigger winners. And so from that point of view, we still think these are great areas of structural change, but we've become much more respectful on the valuation in these areas. And that's definitely a change we've made in the first 6 months of the year in response to, this narrative getting a lot noisier. But it is important to remember that these ideas are going to keep coming. And so as much as I know people want to jump off the tech sector right now, it is one of the big structural changes of our lifetime. And it is all being driven by Moore's law. It's being driven by the acceleration of compute power. Every computer in the world doubles in power every 2 to 3 years. That meant you used to be able to fit 2,000 transistors on integrated circuit. You can now fit 54 billion. As computers get faster, they can do more things. And so again, people might have heard me talk about this before, but the internet, when it first came along, could just send an email. But then it could do search. And once computers got faster, it created search, that creates Google. It then gets on your phone. You can use the internet on your phone because shrink continued. Computers got faster, that creates Apple. You can then send pictures, it creates Facebook. You can stream video, it creates Netflix. You can then play video games interactively, it creates the whole video game sector. It then creates software companies that appear out of thin air because things like Zoom actually work. And then along comes things like Uber and peer-to-peer and Airbnb, where you can literally order a car, you can watch it come to your house, you can go get in it, you can go somewhere else and the payment goes up to the cloud and back, which allows Uber to disrupt taxis. And so the concept of disruption will continue. It has to, because we know that every computer in the world still has another 4 or 5 iterations of Moore's law left in it. And so every computer in the world is going to roughly get 40 to 60 times more powerful over the next 15 years. And so we'd be mad not to keep looking here. Yes, we may have to adjust it occasionally depending on the macro environment, but it's still a good place to look for these big structural winners in the long run. And so that's why we're very much committed to these areas. That said, the last thing I'd say is that, in my second or third last slide of introduction, is the end of COVID has allowed us to go back to a lot of these areas you probably would have heard us talk about before. So emerging consumers come back into the fund in a reasonable way. We bought Airbus back about 3 or 4 months ago in travel. I know people don't think we're doing long haul travel anymore. That's okay, because short haul travel, they actually make more money. because they don't make any money on the long haul planes. Happy to talk about it in the Q&A. Luxury goods, still a great place to invest. So things like Montclair have come back into the fund after stepping to the sidelines through COVID. And drink stocks is a great area for us to look at as well. Semiconductors, really great structural and cyclical story. They are the shovels in this boom. Been a big part of the fund for a long time, still a big part today. And the last big area is climate. We do think the decarbonisation of the planet is the next big S-curve. And so it's a great place to look for these new emerging winners that are really going to occupy that top left-hand corner of that slide I showed you right at the start. And they're really at the start of their structural growth trend. So putting that together, these are the areas of interest that we're focused on in the fund today. And so for those of you who do follow the product, we put this chart in the quarterly every quarter, and it's also, I think, in the monthly, or at least the top 5 are in the monthly every month. And so what we're trying to show you is these are the areas that we're dedicating our research to, because we think these are the areas of big structural growth in the future. On the right-hand side, we're showing you the weight with climate number 1. There's 8 holdings here, of which an indicative position would be Trane Technologies in heating, ventilation, and cooling. The next area is digital enterprise, which is cloud computing, as I said earlier, which there's 4 companies, roughly 10% of the fund. High performance computing is the semis I talked about, and then e-commerce we talked about, internet disruption, digital payments. And down the bottom here is innovative health, and just off the bottom of the slide here is emerging consumer. And so in all of these areas, we expect strong structural growth over the next 3 to 5 years. That strong structural growth should hopefully equal earnings growth for the companies that we have on the right here. Some of them we've got right, some of them may not execute. Some of them might end up being the Nokia, and we'll have to clean them out and eventually find the Apple. But ultimately, if we continue to look in these areas and we continue to find the right companies, then the structural growth will equal structural earnings growth, and the earnings growth will equal share price growth. The last thing I'd just say here is, we don't fill this thing with just a whole bunch of companies that don't make any money. I know we are a growth manager, but in every one of these areas, we are trying to balance a mixture of high and low multiple ideas. And so if we look at digital enterprise, for instance, Microsoft is the biggest area of business, biggest holding there. ServiceNow is the next biggest, and the next one is Adobe. And so from that point of view, it's a mixture of sort of low multiple Microsoft growth and higher multiple ServiceNow. And as I flagged earlier, the one change we have made here is we have sort of lopped the next riskiest idea off this area of things like digital enterprise and also internet disruption. We have lopped the next riskiest idea off just because we recognize that there's a lot of them at the moment. And if anything, they probably have done very well for a number of years for us. And that ultimately this narrative means that they're probably not going to go anywhere for about 12 months. We still like the companies a lot, but we just recognize they're probably a lot closer to the price targets that we have at the moment, and they've pulled a lot of that demand forward. And so we have lopped that next riskiest one on. But we're always trying to balance these areas to try and give you the benefit of, the structural growth will come through. So we know the earnings growth will come through, will ultimately give us the share price. On top of that, we're also trying to balance the areas of interest. So they can't all be driven by the same idiosyncratic thing. And so we do think our climate ideas are being driven by completely different things than, say, for instance, our cloud ideas. So there shouldn't be one exogenous fact that changes the whole portfolio. So that's how we position the fund today. That's what we're looking to do. Look, the last thing I'll just flag really quickly on net exposure and performance. So as you can see here, we do run the net. So this is just for the absolute return fund now. We do run the net exposure over time, roughly fairly fully invested. We do have these drawdowns of exposure here in 2018 and again here in 2020. This is just us having to hedge the portfolio. We're not selling the whole portfolio and buying it back again. We're just hedging it. So what I'm showing you here is the net exposure of the fund over time and the gross exposure over time. And down the bottom is the short exposure. And so what these areas are designed to do is they're trying to protect the downside. And so what we're showing you here is 2018, and what we're showing you here is the COVID quarter. So this is the March COVID quarter, and this is the December 2018 quarter. And in both times, we have drawdowns from our stocks, but things like shorts and put options and currency can help offset that. And in the COVID quarter, that actually meant we made money that quarter, which was a good result. But if you go back to 2018, much more of a rotation. Yes, the tools helped, but they didn't stop us having a drawdown. And this is much more really the environment that we've been through since, I suppose, mid-February till about now. We have had a bit of a drawdown. It's not a huge drawdown, but our tools haven't necessarily helped us as much as they would say in COVID, because ultimately, the market actually hasn't gone down that much. Lastly, this is how the fund's positioned at the end of May. We are 91% gross. It does say 76% net, but you should look at the 91. We're only running about 10% cash. We are running a bit lower risk at the moment just because we're not effectively getting rewarded for taking that much risk at the moment. I think that will get better as we move into the second half of the year as this narrative actually calms down. And then the last thing just to flag is ultimately what we're looking at is just the absolute performance of the fund through the cycle. And so the thing that we try to judge ourselves against, and we'd like you to judge us as well for, is that this number stays above double digit per annum in absolute return through the cycle. At the moment, it's 16, and importantly that we can keep that positive. So ultimately we will give up the relative returns to the upside to protect the downside, and we have had to do a little bit of that in the last couple of months. But ultimately, what that will give you is effectively a lower beta product, so a product that has better upside capture and better downside capture, but ultimately still giving you access to these growth equities through the cycle. And so that's what we try to do with our absolute return product. And then just so we're clear, the long only product is just the same thing, but fully invested with no downside protection tools. So it is 94% long today, but roughly the same top 5. And the performance there, we obviously look much closely at the relative numbers through the cycle. Has a shorter track record than the absolute return fund, but we've actually run it internally since day one. So the longer track record is there available if you'd like to look at it. So what I'll do there is I'll stop. I'll head back to here because I'm sure people are going to want to dive into some of this stuff, the stocks and the areas, but I'll stop there, and I've gone for about half an hour and see where the questions take us, Zane.
Great, thanks, Nick. One of your shorter introductions.
Yeah, sorry.
That was fantastic. I appreciate that. We've got a few questions come through, so please do keep them coming through, and we'll, as I said, answer as many as possible in the allotted time. Good question here. What makes climate change the area of interest different today than, say, 12 or 14 years ago? Because the concerns of climate have been around for some time. Could you perhaps deep dive into that area and explain which are the segments of climate that you actually find really exciting at the moment?
It's a great question. So these are, as I said, are areas of interest that we're focused on. And climate, you'll see some videos and stuff that we look at, and this is climate. So why is it different this time? Dangerous words. So I was actually investing in climate last time, back in 2005, 2006, 2007. And so that was the last big climate boom. And it's funny, actually, the stocks have actually been in our universe ever since then. And so about 2 years ago, we started to dust it off. It was really halfway through 2019 that we really started to look at this quite closely again. And the reason why we did is twofold. In fact, it's threefold. And the reason why I think this time it is for real. The first reason we did is because every company we started talking to started telling us about their carbon reduction targets. And so it sort of became a bit like Australia used to be when it was just nothing but mining companies. And some of us who've been around for a while will remember that every presentation in Australia would start with, your health and safety record and how many people you hadn't killed that year. And so every presentation we were looking at was basically saying these are our climate credentials. And every company we were talking to was committing to a zero carbon target. So people like Microsoft were doing it, Google was doing it, Facebook was doing it. And at the same time, governments around the world were starting to do it. But even interestingly, in the US, this is when Donald Trump was president, states of the US were starting to commit to zero carbon targets. And so the overall political narrative had gone away. So it didn't matter what the politician says, it was going to happen by itself. The second thing that started to happen was people started to ask us about how we invest and are we signatories to UNPRI and things like that, which we then went and did. So we signed up to UNPRI and we incorporated ESG principles into how we pick stocks. And the more people who asked us to do that, the more we had to address how we were looking at it. And this ultimately becomes a self-fulfilling prophecy. And so now, as you look here in Australia, it's very hard to see, but in Europe you can. But if in Australia, I'll use an Australian example. So BHP has a sustainability report. It's the only really big company that has a sustainability report that's audited by EY. So it's audited by someone other than themselves. no different to the way you'd audit your own financials. And in that report, they commit to reduce their carbon every year to a target that they've set. And so that report, they're going to have to do it. I mean, they're literally going to have to do it because it's being audited by EY. And they've set the target and their investors are demanding it. So I would have to assume that it will happen. And on top of that, Europe's done this. And so then let's just drop it all the way. And since then again, so that was all 2 years ago. And then since then again, now the politicians have finally got the message, even potentially Scott Morrison's got the message that you're going to have to do this. And so Europe's committed to a zero carbon target by 2050. Canada, China by 2060, US is going to 50% by 2030. And this is all going to culminate, by the way, in Glasgow in November, where you've already seen Biden sort of put the world on notice that you need to get your stuff together for November, because they're going to really put the agate on you to get this done. And so from that point of view, the last, and I suppose the real tipping point was COVID. COVID ended up being this global pandemic that everyone told you would happen, but none of us thought would. And of course it did. And so now we're focused on the next existential crisis that the world will face, which is global warming. So let's assume that it's the revolution that everyone thought wasn't possible that now has become inevitable. And that's generally how that works. And so our view is you now got to work out how you're going to do it. And so we think it's going to cost roughly between $30 and $50 trillion to decarbonize the planet. It's an amazing amount of money. It's highly unlikely to happen by 2050. These targets are incredibly ambitious. You know, carbon neutral is not, we're not going to emit any more carbon. It means we're going to emit no carbon. And so they're incredibly ambitious targets. That 30 to 50 trillion is going to go into all these different areas. And so I know everyone gets fascinated by electric vehicles, but you know, energy efficiency is actually a bigger opportunity. Renewable energy is a bigger opportunity. Transmission grids and distribution grids is almost the same size opportunity. And so from our point of view, it's a very diverse area, and that's why it's so big in our fund. And if anything, we might even have to split it up at some point. But the great thing about it is you now know, if you just believe everything I said and you know it's going to happen, you know it's inevitable, you can start to price it in. And so this is the amount of wind that's installed in the world today. This is how much you're going to have to get to carbon neutral, roughly. This is how much offshore wind in the world today. This is where you're going to have to get to. And there are a number of companies we can look at that are leaders in this space. Same with batteries. You know, this is battery capacity today. This is where it's going to have to get to. This is battery capacity today. This is where it's going to have to get to. And like these are obviously rough assumptions, but I'm pretty sure we got the direction right. You know, you're talking multiple sizes of market that's going to grow, and all sorts of companies that fit into the supply chain down the bottom here. And lastly, you know, electric vehicles. You know, why did Tesla go from 50 billion to 600 billion last year? Because everybody suddenly realized, unfortunately, all at the same time, that 3% of electric cars, which is what percentage of all new cars last year were electric, is going to go to 60%. Now, Tesla, lo and behold, was 26% of all those 3% of cars last year. So if Tesla held that market share and the 3% goes to 60%, then Tesla's going to sell 30 times more cars. So 20 times more cars next year in 10 years' time. So that would make it the largest car manufacturer on the planet. So people aren't valuing Tesla on next year's earnings. They're looking out to 2030 and saying how many cars they're going to make and discount it back. And I think that makes sense. The problem for Tesla is it's all now priced in, and maybe too much is priced in because you don't know if they're going to hold the 26% share. But this has to happen in other places. It can't just all go to Tesla. There has to be other companies that are going to win from this. And so the big ones, and the last thing just to point out here is if you look at energy efficiency particularly, you know, you're even going to end up with quite boring companies or companies that you probably wouldn't expect us to be looking at, like heating, ventilation and cooling companies, who really are the source of all building efficiency, building emissions. And so every building in the world is emitting carbon. It's emitting carbon because of their HVAC system effectively and their lighting. And so when BHP redoes that sustainability report every year, the way to get the numbers down is to focus on, insulation on their building, focus on the lighting, focus on the HVAC system. Are they using fuel oil, or should they move to an electric pump or a heat pump? And most of the buildings in the world, particularly in the Northern Hemisphere, are running off fuel oil or gas, and they need to switch to electric. So from our point of view, a couple of just simple opportunities just to flag would be Vestas. You're only paying 15 times EBITDA, 25, 26 times earnings. There's actually only 4 wind turbine manufacturers in the world that have a strong lead at the moment. It's very hard to catch up. The technology is quite difficult, but more importantly, a bank won't give you financing if you use an untried wind turbine manufacturer. And so it seems like a good way of playing this growth. And so is one fairly simple way of looking at this. Thinking a bit more left field would be Trane Technologies, which is one of the world's largest heating, ventilation, and cooling providers. Ultimately, seeing really strong growth at the moment as they effectively retrofit half of Europe for heat pumps and different types of heating and cooling systems that are ultimately less energy intensive or more energy efficient. So this tailwind basically gives them high single-digit revenue growth, double-digit earnings growth for a very long period of time, and we're not paying big multiples for these things. And so from our point of view, we like the area because A, we're right at the start, so the runway's in front of us. And B, most importantly, none of the companies are very big or expensive. You're finding, I'll take you all the way back to the Apple example. When we bought Apple all the way back in 2009, 2010, we paid 15 times earnings for it. Like, it was not expensive, yet the opportunity was there because people just couldn't see it. In technology now, it's harder because the multiples are much higher. Everyone's worked out the game. But over here in climate, they haven't. We're still paying, 20, 22, sometimes in 30 in this case, or sometimes as low as 15 times earnings for companies that we feel have strong runways in front of them. They won't be as good as the digital companies because they're physical, but they're also nowhere near as big. So they're quite good opportunities. There won't be a winner takes most. It'll be a conglomerate effect, but it's just a great place to look at the moment, and one we're super excited about.
Great, thanks for that answer, Nick. Another question here. So with the cryptocurrency market cap recently surpassing 1.8 trillion, what's your stance on financial services and digital payments? And do you have any allocation to cryptocurrency type stocks?
So we have no allocation to cryptocurrency, and we won't. We'll let you do that yourself. Not necessarily against cryptocurrencies. But our job is to find companies that have people who run them and execute earnings growth over a long period of time. So from our point of view, we think it's a really good opportunity. And so in digital payments is the area that you're talking about. So 10 years ago, and I was doing this, unfortunately, you'd walk into someone's office and say, cash will disappear forever. It's sometime in the next 20 years it'll disappear, and everyone would go, that'll never happen. But now I think everyone on this call can now see the light that cash is actually just going to disappear. And, you will be telling, our children will be telling their children about the time they used to get pocket money, and not many kids get pocket money anymore. So cash is actually going to disappear within the next generation. When it does, some funny things are going to happen. And so it's important to think about this, and digital currency has a role to play. This is a really, really good opportunity for the fintechs, because the fintechs have generally just operated in things like e-commerce or digital consumer financing or buy now, pay later, or all these things that Afterpay does, and lots of these other fintechs like PayPal and Square do. Well, what will happen is once cash disappears, you can effectively bank with your fintech, and you can move into all these other areas like in-store retail, cross-border payments, domestic non-cash payments, paying bills, et cetera, et cetera. It's a great opportunity for the fintech to drag you into their ecosystem. And the reason why this is such a good opportunity, because there's so much ecosystem to go for. So this is just a good slide that the guys put together. This is the revenues of the top 30 banks in the world, and this is the revenue of the top 30 fintechs in the world. So here to here. And so the banks really only exist, and there's thousands of them, not just a couple. Like, there's more than 5,000 banks in the world. There's more than 10 in Australia, I think. There's more than 3,000 in the US alone. And these banks are basically there because they were the regional area to collect cash. you went to the Bank of New South Wales because that was how you took the day's taking, if you know what I mean. That was where you took your money to keep it safe. And then you took your money out. Now, over time, you've used them for other things and you've had a much more digital interaction with your bank. But inevitably, once cash disappears altogether, then the banks can only compete in a digital world. And so you should eventually get this sort of winner takes most effect. And these fintechs can actually bring you into their ecosystem because they can just do it cheaper. They do it cheaper with foreign exchange. They do it cheaper with peer-to-peer payments, et cetera, et cetera. So we like PayPal, but you could also say the same for Square. Cryptocurrency is just another service they provide. And so all of these fintechs are going to go to this point where they're providing all of these services. Cryptocurrency is one of them, but there are lots of other things they do. And they use as an acquisition tool to bring them into your universe and then for you to use them going forward like you would use a bank or use other things. And so that just gives them this incredibly long runway of growth. Cryptocurrencies, just to finish, why do people like them so much? Because inevitably, if you follow this logic through that I just gave you, inevitably, you don't see it. If you don't need currency anymore, then why do you need currencies from different countries? And so there is a need for a digital currency. It is expensive to transfer money out of Aussie dollars into US dollars into Canadian dollars. And a digital currency would solve that problem. And all you're seeing is lots of people betting on which digital currency it would be. So we'd just rather play the shovel in the boom, and that's PayPal and Square, because we don't actually know which currency it's going to be. And we know that there's going to be lots of regulation and issues along the way that we know that PayPal can negotiate, and obviously these currencies might not be able to. So PayPal's really your catch-all way of playing it. It's a lot cheaper than 52 times earnings now. I'm afraid it's closer to 45, but it is, highly priced, but not ridiculously priced, because the earnings should double every 3 to 4 years now for quite some time as they continue to bring people into their ecosystem.
Thanks, Dick. Another question here. So you have very little exposure to China at the moment. Is this a valuation concern, or is it tied to governance, or what are your thoughts? What would you like to see as in China for you to up your allocation in that space?
Thank you. Good question. So people would know that in the past we have had exposure to China. So Alibaba's been here in the e-commerce area. We do still hold Tencent today in the video game area, but in small size. China's a wonderful opportunity mathematically. 1.4 billion people who and more importantly, China, doesn't let the US companies in. So you have a job to find. You can actually find the Amazon of China, or you can find the Salesforce of China. You can find the Microsoft of China. And so that's what Alibaba is. That's what Tencent is. Sort of what JD.com is, et cetera, what Ant Financial would have been. From our point of view, we were incredibly disappointed when the Ant Financial IPO got pulled. And we halved our Alibaba that day, and we since sold the rest of it because of the clampdown. Mathematically, these stocks add up, and they look like great opportunities, but I can't sit here and look you in the eye and tell you I know what's going to happen next in China. Things aren't playing out the way we thought they were. The regulation crackdown has gone well beyond what we thought was reasonable. And as a minority shareholder, we're just not comfortable sitting there. So we took a view that we would reduce our exposure to less than 10%. Then we took a view of 5% and below 5%, and that's what we're doing today. And if something materially changes, we'd love to go back. But we're going to need to see some changes at some point for us to go back there. So for now, we're just taking a pause on China and waiting to see how things go. But that's mainly a risk management call. The opportunities there are still profound, and I had very, very high hopes for it in the future, and I hope that we can in the future again go back there and start to look at some of those opportunities more closely, with confidence that we'll be looked after. But capital goes to where capital's treated best, and capital's just not getting treated very well in China at the moment. So why don't we just take it and go somewhere else for a while?
Great, thanks, Nick. Another question here, I think it'll lead into the next one as well. Now, I know a lot of fund managers like to meet management and press the flesh, so to speak, with the companies in which they're investing, and like to see what's happening on the ground. How have you and the team found the past 18 months of COVID lockdowns? Has it made it more difficult, or are you getting even better access to companies?
So we're definitely getting better access. So there's good and bad things that happen. The good thing is you get much better access. So if you want to, if you want to get Amazon on the phone now, you can. It used to be quite hard, and we've owned the stock for a long time. But you can now get them on the phone quite easily and hook up a Zoom. And so we've definitely, with a lot of our companies, the relationships we've built with them have got stronger through COVID because they're not traveling and we're not traveling. So getting them on a Zoom is quite simple. That's the good bit. And so from that point of view, it's very helpful. But, international travel will need to start up again. Ultimately, we built the process we have over 15 years by doing 500 company meetings a year and traveling extensively and seeing things. And generally, I've found it's the things you're not looking for on a trip that generally can change your view on things. And so my one observation from COVID is, if you keep dialing the same people and asking the same questions, they'll tell you the same thing back. And so it's a great way to form a bit of confirmation bias because you don't actually, you have to actively look for the other point of view. You won't come across it. And so from that point of view, it's been great for getting access to our core holdings. Our relationships are stronger with them than ever. We've definitely been able to build up new ideas quicker than we would have previously. But that really different idea, that really left field idea, you're just not getting in a COVID world, and that's gonna have to come from getting back on the road. And so looking forward to doing that in the 12 months ahead. So that'd be my balanced answer on that one.
Thanks, Nick. A question here on a couple of companies that you mentioned in your introduction. So you've commented on HelloFresh and Uber. Now I'm personally a subscriber to both HelloFresh and Uber, both regularly. One company clearly benefits from us being in lockdown, say HelloFresh, whereas the other would likely benefit from a reopening in Uber. Firstly, are these companies still in the portfolio, and what are your thoughts on the two companies and their opportunities still in front of them?
Yeah, it's a great question, actually. So Uber's a bit both ways, obviously, because the food service actually benefited through lockdown, whereas the car service didn't. I'd actually think of it completely differently. I just think of it as and the great way to think about, Uber is it's really, and let me cover Uber quickly and then I'll talk about HelloFresh. Uber is just the next in the chain of the big internet companies. So if you think about your mobile phone, okay? So generally, if an app makes the front page of your mobile phone, it generally gets to about $500 billion. So if you think about Google or Facebook or Instagram or YouTube, etc., or Netflix, etc. And so Uber's sitting there on the front page of your phone, but it's an 80 billion market cap today. Yet the dollars you're spending on Uber far outweighs the dollars you're spending on these other apps. So Google, statistic, you can actually work out the math that Google makes about $50 off every user every year. And it makes $50 off every user every year through selling you ads. Facebook in the US makes about $35 per user, and in the rest of the world about $12 per user every year through selling ads. You are spending vastly more than that on Uber every year. Yet Uber is obviously taking that money and spending it on building out its network in other countries, et cetera, et cetera. So once Uber gets that sort of domination and stops spending money to win, so right now it's in this money fight with all these other people. Eventually, once that money fight slows down, and you're already seeing it start to slow down in places like Australia and other places, and you move into these oligopolies, it's going to become an incredibly profitable company. And so people are just looking at the profitability saying this company's not profitable, but its revenue growth is phenomenal. It's a platform just like the other guys were, but you're spending more money on it. And so the 100 billion, mathematically can get to $1 trillion in market cap quite easily, just by it becoming more profitable over time. And I can't see why that won't happen. And so this is no different to, when Google listed at $50 billion market cap it listed at, and a PE of 100, okay? And now Google's $1.6 trillion market cap and a PE of 25. So when was Google cheaper? Was it cheaper at 25 times earnings or 100 times earnings? It was cheaper at 100 times earnings. You just had to do the work. That's all we're saying with Uber. It's a not profitable company now, but you can see this path to the future. And so we're looking at it very much like Google was back then. HelloFresh, completely different. HelloFresh is really just part of this e-commerce acceleration and this e-commerce acceleration that we see here. And so HelloFresh is just about taking the next category of e-commerce that's going to go. And so if you look at e-commerce, so everybody on this line has dealt with, bought stuff online. And you probably started buying, electronics and toys was probably the first two things you started. And then over time, you got used to buying sporting goods. And then you started buying clothes. You probably remember the first time you bought clothes online. You're like, oh, is it going to fit? Will it go back? Then you started buying furniture online, okay? And so now the one big one that hasn't gone is groceries. Groceries is going to go. Groceries is going to go online. And that's what you discovered through COVID. And it's actually the biggest TAM at $1 trillion, but it's the least penetrated at 3%. And so what's interesting about this is all HelloFresh is with meal kits is over here. HelloFresh is actually the #1 meal kit operator in the world today. It's 10 times bigger than its nearest competitor at Blue Apron and Marley Spoon. And so all HelloFresh is actually doing, people are just missing the point. It's not actually a meal subscription plan. It's just an easier way of buying your groceries. And so actually who they're trying to beat is these guys. This is the TAM they're taking, the supermarket. And so if you're not using it, if you ask anybody who uses it, they'll all say the same thing. They use it because it's easy, because they just don't have to think about what to cook every night. They're not doing it because they love the meals that they're creating. They're doing it because all the food, all the groceries get delivered, and then they just have to cook it. And you're not doing it every night. You're only doing it 3 nights a week. So HelloFresh is just a replacement for your groceries. And the great opportunity here is there's just so much TAM to work into. And so from that point of view, their #1 market share in the US is so much TAM to walk into. So coming back to the point is has they, yes, they picked up a lot of new customers in COVID, but what we've seen quite clearly is that's actually just kickstarted the network effects. And so what's fascinating about HelloFresh is everyone thinks it only trades on 22 times EBITDA. It's only 30 times earnings. It's actually only a 11 billion euro company. It's tiny, or 12 billion. Yet it's got the biggest opportunity we've seen for a very, very long time. And so everyone's getting hung up with the customers are going to slow down because COVID's going to go away. And they're just completely missing the point that the network effect has now started. You've all got used to buying food boxes. And so the flywheel will continue. And we know this for a fact because here in Australia, they've continued to grow for the last 6 months, even since COVID ended. And so we have these hysterical conversations with our German analysts, by the way, where they go, as soon as COVID's over, everyone's going to turn HelloFresh off. And we go, well, hi, we're calling you from the future. COVID's over. And people are still ordering HelloFresh. It's grown every month since COVID ended. And so honestly, we think this is a genuine 10 times your money opportunity. It's probably the best idea we've found since Amazon in a very long time. And I know you might think we're smoking crack because you've probably ordered a box and had a bad sweet potato. But people are just completely missing the point of once you get a box delivered to your front door once a week and you get used to it, what else can they put in the box? They can put the milk in, the pet food, other groceries. And so it's just a phenomenal opportunity and it's been completely missed because it's hiding in Germany. And yeah, we really, really like this one. So don't get hung up about the short term. I agree, there might be a few bumps, but the medium term looks fantastic.
Thank you, Nick. Probably time for one more question, and it sort of probably leads back to where you started your presentation. Over the past few months, we've seen growth names pull back as a part of the rotation on the back of inflation expectations. Firstly, as an absolute return investor, what capital protection tools do you have to deal with this? And then from a portfolio perspective or a company perspective, how do you approach this risk?
Yeah, okay, great question. Just trying to think what's the best way to cover this one. Yeah, let's talk about this. Okay, so we talked about interest rates at the start of the presentation. So if we work on the assumption that that this is correct, okay, rates aren't going much above 4% in the long run, then and if they do, then we've all got a problem, okay? Let's assume everyone's happy with that part of the answer. So then how do we manage the 1.5 to 3 or the 1.5 to 2.5? How do we do that? And the simple thing to do is to just lower the multiple of your overall portfolio. So just accept that the higher multiple stuff is going to struggle for a little while, and that you really want the earnings growth that you're looking for to come through. And so from our point of view, the best way to do that is to lower the overall multiple of the portfolio. So we've actually already done that with the changes we made here. And so if you lower the overall multiple portfolio, ultimately the earnings growth will drive the stock prices. Otherwise, you just get earnings growth, but the multiple keeps coming down. You get earnings growth, but the multiple keeps coming down, and you don't go anywhere. And so that's the first thing we do. Second thing, from a capital protection point of view, yes, we have shorted things like bonds so far this year a few times that have worked out quite well as a hedging thing. That's one hedging tool. We've bought puts on the US 10-year Treasury, which worked out quite well with that first move. Third thing we can do is we can, buy puts on the NASDAQ, for instance, as capital protection. But generally, it's quite hard to add a ton of value doing that. We've added about 100 basis points this year doing that. And I'd be surprised if we managed to add much more than that. But yes, the capital protection tools will become in very handy if we do end up in that horrible stagflation area period up here, because if this happens, then everything's in trouble, and that's when the capital protection tools will come through. So from our point of view, lower the multiple portfolio, let the earnings growth shine through, because that will drive the share price growth, and don't let the multiple be an impediment to the earnings growth working. That's the main changes we've made. The last thing I'd say, which is super important, and it gives me a chance to do it, I think I skipped it in the presentation, I did. Don't lose sight of what you're meant to be doing here, okay? Remember, it is the narrative of the day, we think. There is a tail risk. I'm not saying there isn't, but I do think it is effectively a narrative of the day. But at the end of the day, your job here is to find earnings growth. This is just a great slide that shows you Amazon. We've owned Amazon now for nearly 10 years. We bought it back here in 2014, actually. And at that time, it was forecast to earn 10 billion in EBITDA. 10 billion in EBITDA. But as we know, Amazon's positioned itself perfectly for the structural growth of e-commerce and cloud computing. And because they did that, their EBITDA grew from 10 billion to 70 billion. Okay, so it went up 7 times. And their share price went up 7 times. And so the share price has actually perfectly followed their earnings over a 7 or 8 year period. But along the way, it has re-rated and derated and re-rated and derated lots of times. So this is the EBITDA of Amazon. This is the EV to EBITDA multiple of Amazon. And so what you can see is it basically went as high as 25 times, back to 15, as high as 30, back to 20. We bought it at 20, it's still 20 today. And every time it re-rates and derates, it's actually because of nothing that Amazon does. It's because either Donald Trump got elected, or Jerome Powell's talking about rates, or inflation's coming back. But the important thing to remember is that ultimately it will follow its earnings growth. Now, the 70 billion is well on track to go to 150 billion. That's going to happen because the cloud has only just started and e-commerce is only about halfway through, and they're positioned perfectly in both. So they will follow that tailwind all the way to 150 billion, assuming they don't get regulated or something. And then along the way, this may continue to derate back down to here, but if the earnings go up 100%, the company derates by 20%, we're still going to make 80%. Or if the company derates by 40%, we're still going to make 60%. And so from our point of view, it's important to remember that these narratives of the day, yes, they cause the re-rating and deratings, but ultimately it's the earnings that will matter. The other simple way of thinking about it is interest rates and inflation may change the price you pay for a company, but it won't change who actually wins in the long run. The same companies will win in the long run because that's what's actually happening in the real world. And so our job is to focus on the real world, find the structural growth trends. The earnings growth will equal the share price growth, provided you don't pay too much money for them. And that's simply what we're trying to do here today. Last thing, just to flag, since I suspect we're going to finish, and I've gone well over time, is just to flag, we do update. We are very transparent about what we're doing with these videos that we show on the areas of interest we're looking at and the stocks we're looking at. And the reason why we do that is because we recognize that this is a journey we're on, recognize there's times when it's going to be easy and when it's going to be hard, and we recognize clients ask questions about that. And so please use these resources to ultimately tell that story, because ultimately that's what we're trying to do, because that's the best path to getting you the superior risk-adjusted returns through the cycle, and that's why we do it. And so I suppose that'd be my last answer, Zane.
Great, thanks Nick, thanks for your update, and thanks for everyone's fantastic questions. Just in closing, on behalf of GSFM and Munro Partners, thank you all for attending the session today and for your fantastic support. As Nick mentioned, Munro produce great insights and media, which can be found on their website, their YouTube page. I'm sure you get plenty of my emails and calls on a regular basis. We hope you enjoyed the presentation and gained some valuable insights as to why the Munro Global Growth Funds represent a great opportunity today